I think there's a certain sense of that. Yeah, like let's say the stock market, the New York Stock Exchange, and there's a certain comfort in knowing that when the markets close on Friday afternoon, then we get a break, and then it doesn't matter what happens with if a bomb goes off in Iran or something. It's not until Monday morning, the opening bell, where we know what happened. And so the idea of it, what if it's just open 24/7 and you can see it, it's almost scary to people.
Absolutely. But then when you peel back the layers and you kind of figure out why is it this way? Well, because humans and even machines needed breaks, needed maintenance, needed rest. And so it's almost a question of, well, why not? Why wouldn't you have 24/7 if you could? And having to wait between Friday and Monday when bombshell news about your investments have now become public, and you're a small retail investor on a Charles Schwab system, and you're last in the queue on Monday morning when the orders go into the exchange, right? But then they're already queued there. Mm-hmm. So there's definitely this whole democratization, and the average Joe should have the same financial capabilities and as all of the established players. That's a bit of a romantic kind of thought, but we will definitely see that gap closing just by virtue of some of these technologies. On INX, for example, and when we talk about real world assets being tokenized, if you take a private company that's doing a raise, $5, $10, $15 million to start their business, and are going with the security token offering route to retail and accredited investors in certain jurisdictions, you suddenly have the same game that has been played exclusively by VCs over the last, decades, and the large financial players is now being played by retail, by average people around the world. And that's great. Although on the flip side, there's also an educational aspect that has to come with it, because retail doesn't understand these types of investments the same way as those institutions that have been doing that for years. So whether you have the technology and you're bridging these gaps into these, doing the democratization is one thing, but being able to support through education and basically carrying along these retail investors and helping them understand the opportunity, both are required. The technology alone isn't enough. We as pioneers in the space have a responsibility to make sure that we're educating and we're breaking down these opportunities and these seismic changes in capital markets in a way that, retail and this new class of investor can understand.
Do you feel a certain, responsibility that, hey, you're a pioneer in this area, and like you mentioned, there's a lot of other bad actors, either through incompetence or malice, giving certain things a bad name. So it is really up to us to really be above board so that we can show, hey, this is a viable approach.
Absolutely, Bob. You have no idea. I mean, first of all, when you do things the right way and you play by the book, effectively you're kind of walking a narrow path, right? Mm-hmm. And that slows you down in some degree, where you then see all these other players just doing stuff without, and there is no way they have the regulatory approvals or the oversight or things like that. And then the news breaks months, years later, and you're like, we saw that one coming. It really has been damaging for the space. But the more responsibility then rests on our shoulders to tell our story as to how you should be doing this, how it can be done, and how we have been doing it. So absolutely, we definitely, we wrote a book in 2 years ago or so. It's called the INX Way, where we talk through all of the various opportunities that exist in the tokenization space. We put out a press release sometime last year about things like how we do custody and how we do very clearly segregated custody of customer funds from corporate funds and things like that. All of the things that have gone wrong out there. So it's definitely a responsibility that sits on our shoulders to prove that you can do capital markets and crypto and digital assets and security tokens all by the book, and kind of draw a line and say there's the bad way of doing stuff, and witnessed through the stories that we've seen. And then there's the INX way, for example.
Mm-hmm, mm-hmm. Just to circle back, you mentioned the democratization. So, like, you think of something like transportation back in medieval times. If the king wanted to go somewhere, he'd get his horses and his retinue, and it would go. Whereas the peasants were walking. And then now that there's automobiles, sure, somebody rich is going to drive a much nicer car than somebody who is just a blue collar worker. But the difference between the rich person's method of transportation and the poor person's is much smaller now than it was in the year 1500. And so likewise, do you think there's a similar thing here where these new technologies are going to empower? So yes, the head of a multinational corporation is always going to have an edge, but is the smaller retail investor now, or does this help them gain somewhat in the grant book relatively?
Absolutely. So, I mean, think of an example here. Let's take Switzerland, for example, right? Switzerland put out blockchain legislation a couple of years ago. And one of the things that they've put out in their regulation is that privately held companies are able to tokenize their shares and make those available directly on their website to retail investors. And that's huge. That's significant, right? The fact that up until that point, how would a Swiss retail average Joe go about investing in an exciting, let's say an AI startup, right? Where everyone's clamoring for getting on the AI train. And now you could go to any of the AI startups in Switzerland that have chosen to tokenize their shares and make those available and invest the exact same way as private equity and others would, and VCs would traditionally have invested in. So that's a very good example of how this is empowering, well, closing that gap as you described. But then again, there's two things there, right? There's the technology that makes it possible, but there's also the regulation. So you have to have the regulator understanding the need to empower and create the democratization. And that's important, right? It's one thing to say we're just here to kind of protect investors. It's another thing to say we're here to create better access to financial markets for the average investor. And that's important. That's an important distinction.
Well, it's funny. There always has been this tension, at least to my mind, like in the whole idea of an accredited investor. In other words, it's like, oh, there's these types of investments and funds and blah, blah, blah. The rich people are allowed to get into. And so why do they want to get into there? Well, because obviously they must be pretty good investments if that's where the rich people want to put. But we don't let the poor people get into there because, oh no, this isn't for you. There is a sense in which it's like an old boys club. But on the other hand, I get the flip side is to say, well, these things are speculative, maybe, and they're risky. And so there's a difference between putting your money in some private equity firm versus just a blue chip stock.
Yeah, I don't want to comment on, the whole kind of echelons of,
Right.
But what I will say is, and again, there's an example
You
here.
could just say they're all doing a fabulous job at the regulatory,
Well, I would say during the Obama administration, the Jobs Act was passed. And in fact, the father of the Jobs Act, David Weil, is the chairman of the INX board of directors. And when you look at the Jobs Act, it basically translates to these regulated ways for companies to raise capital or for people to invest. So for example, you have the IPO, F1 or S1, which is the creme de la creme of capital raising. And then you have lower barriers to entry called these filing exemptions, like a Regulation S, Regulation D, where companies can raise capital, say under Regulation S, from any retail investor anywhere around the world. And so that's another good example of an administration putting in a structured way so that investors, so just not just accredited investors, are able to participate should the company doing the issuance choose to. So they could do a Regulation A offering, whereby they would be able to raise from any United States investor, regardless of being accredited or not.
Okay. So you're based in Cyprus, right?
Correct. I'm based out here in the Eastern Mediterranean.
So were you out there, back when the banking crisis happened?
No, I was based in London for, I did most of the 20 years of my traditional finance background was based out of London and New York. I worked for, large interdealer brokers and mostly dealing with institutional clients. In fact, in 2008, I was literally on the coalface of global foreign exchange when it all went down and when Lehman Brothers collapsed. We were there until 4 a.m, kind of pulling credit from various counterparties. It was pretty crazy. So yeah, it's been interesting kind of seeing the transformation and seeing what was the focus of financial markets as a whole, technological transformation, high speed, high frequency trading, black box algorithmic trading was the thing then. And then now suddenly you have this whole new asset class and it's crypto and it's not regulated. And you have a lot of existing players wanting to have a slice of that pie and somehow figuring ways to do it offshore or sitting back and waiting for the ETF. It truly has been, very interesting in the last 20 years.
Well, the reason I wanted to ask was, at least in certain circles that I'm in, Cyprus was a good example of to say, this is what can happen. Like the banks will just shut. Because in the United States, at least, there's a presumption that, hey, if your money is in the bank, it's pretty safe. And then we were trying to show
the 2013 haircut here in Cyprus.
So that, but also the shutdown, the holiday where people just couldn't get their money at all. And then you're right, like some certain people, they called it bail-in instead of a bailout.
Yes.
So anyway, that was always like a poster child for, again, some people that I know where they were recommending other asset classes and saying, don't think because your money is in a regular commercial bank, and even if the FDIC backs it. Anyway, so I was wondering,
there's various structural risks to, or risks that affect your money, whether the money sits in the bank, but now there's hyperinflation and because you're in Argentina or you're in, some of these other countries that have seen really poor performance of their currency recently. That's a whole different way. We look at quantitative tightening or easing or the Fed printing, trillions of dollars. There's different ways to look at how your money could be at risk. And this is kind of where the crypto guys come from, which is like, well, if we just do crypto, then it's never going to happen again. Everyone's going to be able to have absolute freedom and control over their funds. Yes and no, right? So in places like Argentina, if you could hold your pesos in stablecoin, USDC or Tether, that's great. But then again, that's not so straightforward over there. So truly exciting times. And, I'm really, really curious to see how this is going to play out, right, over the next 5 to 10 years.
Yeah, and what you're doing is helping, and so sort of you're giving people more options, more flexibility. So you're right, each particular place you could park your wealth, there's pros and cons, and just like giving more flexibility, presumably people will be able to weather the storms more nimbly.
Correct. I mean, like when I look at what we've achieved, apart from the technology and the licensing, but just looking at the solutions themselves, because we really should talk about the solutions and less the technology, is the fact that today on INX, you have companies raising capital. One of them, for example, is a Chinese logistics and trucking company. And they are cash flow positive and they've paid dividends out to their investors twice. And these investors are spread out across 85 countries. Like there's people who would never have had the opportunity to invest in a startup in China, in one of the very exciting industries in that space, which is logistics and freight. So we are really kind of breaking these barriers and it's all about getting this message out there now. And this is why we're grateful to podcasts like these is really to help people understand that there is try to shut out the noise, try to filter the crypto story. We've come from 2008 when the technology was born and we've had some turbulent years, but let's really look at where traditional finance is saying that's the use case for crypto.
Right.
That's the actual use case that we are investing in. And we put our names behind, whether that's BlackRock or Citi or Goldman's. And that's where investors should be looking at now. And in fact, I was looking at this survey of fund managers the other day, and a huge percentage, I think it was like 73% of fund managers were saying that they were actively working on tokenizing. So there's a lot more traction, or there's a lot more intent to adopt technology than is obvious right now. And I think now that we're out of these last difficult 2 years and we're heading into, soft landing, Fed will start cutting rates sometime in May, potentially. markets are looking up. I think we're going to see a real acceleration of this tokenization of real world asset story. And it will happen both at the large traditional financial player level, but also at the retail level. And that's where INX is operating.
Okay, great. Yeah, that's the dovetails with the message, the narrative we've been saying here on this show. I think 10 years from now, it's going to be obvious, and people are going to be like, "Oh yeah, remember back when this seemed like a newfangled thing, and people weren't sure if it would be like, remember when people weren't sure if the internet was going to be a big deal?" So,
Absolutely.
well, I know.
Yeah,
Yeah,
and we
I know.
evolved. So there was a time it was, who's AOL and who's Yahoo and Google?
Yeah.
What are these funny names of these platforms? And it's the same, like what's Cardano and what's Solana and what's, what are these funny names of these? It's a cycle that's just happening again. And I think, like you said, in 10 years' time, we're going to be using applications or wallet features and not talking about the blockchains that sit behind them.
Yeah,
potentially. So yeah.
Hey everybody, this is Bob Murphy. Thanks for listening to this clip from the InFi podcast. If you like what you heard and want to hear more, please consider subscribing and share this video with others. We've got new episodes dropping every Friday with more insightful discussions. Stay tuned.